Hello, and welcome to another edition of Market Brief After Hours. It is great to have you with us as we unpack the trading day that was. It feels like the markets are suffering from a bit of vertigo after those recent record highs, doesn't it? We saw a sea of red across the major U.S. indices for the second day in a row this Wednesday.
That's exactly right. It was definitely a risk-off kind of day, or at least a take-a-breather day. The momentum we've seen recently just hit a wall, specifically in the technology sector. Investors were trying to digest a very mixed bag of corporate earnings, some fresh inflation data, and, of course, the ever-present geopolitical headlines. It wasn't a crash by any means, but certainly a retreat.
Let's get straight into the numbers, because I know our listeners want to see exactly how much damage was done. We mentioned the tech sector took the brunt of it, so how did the major indices shake out?
So looking at the big board, the S&P 500 marked its second consecutive daily loss. It dropped 0.53% to close at 6,927. The Dow Jones Industrial Average held up a little better, relatively speaking, but still finished in the red. It dipped 0.09%, that's about 42 points, to settle at 49,150. And then there is the Nasdaq Composite, which, as you guessed, led the declines. It shed a full 1% to close at 23,472.
Those are the rounded numbers, and that 1% drop on the Nasdaq really sticks out. What was the specific anchor dragging it down?
It was the semiconductor space. We were seeing some jitters regarding potential export restrictions again. Specifically, there were reports about restrictions on NVIDIA's H200 chip exports to China. That spooked the market. NVIDIA lost over 1%, Micron Technology was down over 1%, and Broadcom took a significant hit, falling 4%. When those giants stumble, the Nasdaq really feels it.
And it wasn't just tech, right? The Dow was down too, so the pain was somewhat broad-based.
True, but the Dow's decline was much more modest. It was weighed down by some financials. We saw Wells Fargo, Bank of America, and Citigroup contributing to the downside, even though some of their earnings weren't terrible. It just speaks to the general sentiment. Investors were looking for reasons to sell rather than buy today.
Now, while the U.S. was pulling back, it seems like the rest of the world didn't get the memo. The action in Europe and Asia was actually quite positive.
It really was a tale of two markets. European equities largely finished higher. The Pan-European Stock 600 actually edged up about 0.2% to touch a new record high. There was this interesting geopolitical focus over there regarding discussions about the future of Greenland, talks between U.S., Greenlandic, and Danish officials, which seemed to keep things interesting.
Give us the breakdown on the specific European indices.
Sure. The UK's FTSE 100 gained 0.46%, closing at 10,184. In Italy, the FTSE MIB added 0.27% to reach 45,647. It wasn't green everywhere, though. The French CAC 40 dipped 0.19% to 8,331, and the German DAX slid 0.53% to 25,286. But the standout was Switzerland. The benchmark SMI recorded a strong gain of 0.75%, reaching a new all-time high of 13,490.
And moving over to Asia, Japan seems to be having a moment. I keep hearing about this Takaichi trade. What is driving that?
This is fascinating. Japanese stocks surged to record highs on speculation that Prime Minister Sanai Takaichi might call a snap election in February. The market loves this idea. The Takaichi trade essentially bets on pro-growth economic policies and a weaker yen, which is great for their exporters. The Nikkei 225 climbed 1.48%, smashing through the 54,000 barrier for the first time to close at a record 54,341. The Topix was also up 1.26%.
It's incredible to see the Nikkei at those levels. Before we move on to commodities and the economic data, I want to touch on the U.S. bond market. We had some data releases today. How did Treasury yields react?
Yields actually moved lower, which usually helps stocks, but today the tech sell-off overpowered that dynamic. The benchmark 10-year Treasury yield fell over 2 basis points to 4.144%. The 2-year yield dipped to 3.518%, and the 30-year dropped to 4.794%. This was largely in response to the wholesale inflation data.
Right, the PPI data. We also had retail sales. What was the takeaway there?
The data was actually quite Goldilocks-esque. Not too hot, not too cold. The Producer Price Index, or PPI, rose a modest 0.2% for November, which was slightly below expectations. Core PPI was flat. However, on a year-on-year basis, headline PPI is still up 3%, so inflation isn't dead yet. On the flip side, the consumer is still spending. Retail sales advanced 0.6%, beating the forecast of 0.4%. So the economy looks resilient even if inflation is sticky.
We are going to take a very short break. When we come back, we need to talk about what is happening in the commodities market, specifically a massive move in silver, and we'll break down the technicals on the Forex pairs. Stay with us. Welcome back to Market Brief After Hours. Before the break, we were discussing the equity markets, but looking at the commodities board, there is some serious volatility happening. Let's start with oil.
Oil prices retreated today. We saw U.S. crude fall $1.02, or 1.67%, to settle at $60.13 per barrel. Brent crude was also down about 1.5%. The driver here was geopolitical, specifically comments from President Donald Trump. He suggested a potential de-escalation of tensions with Iran, noting that reported killings there were ceasing. The market interpreted this as a sign that immediate military action isn't on the cards, which took some of the risk premium out of the price.
So oil is cooling off, but precious metals are doing the exact opposite. Gold is marching higher, but silver went parabolic.
Parabolic is the right word. Let's look at gold first. It surged almost 1% to close at $4,630. Technically, it is looking incredibly strong, trading significantly above its 50, 100, and 200-day simple moving averages. But silver was the absolute star of the show. It surged 7.19% in a single session.
That is a massive move for a major commodity. Where did it close?
It closed at $93.16. It hit a high of $93.51. This is driven by intense buying interest, pushing it to fresh multi-year highs. If you look at the technicals, silver is positioned dramatically above its moving averages. For context, the 50-day SMA is way down at $62.56. We are talking about a $30 gap between the trend line and the price. That is profound bullish momentum.
Speaking of bullish momentum, we have to mention Bitcoin. It seems to have woken up from its nap.
It certainly has. Bitcoin surged past the $96,000 threshold this week. It's been fueled by strong inflows into the U.S. spot Bitcoin ETFs and that softer inflation data we mentioned earlier. It broke through key resistance between $94,000 and $95,000, which triggered a wave of short liquidations. It's officially out of its consolidation phase.
Let's shift gears to the foreign exchange markets. For our listeners who track the technical levels, what is the setup looking like for the British pound?
Sterling is gaining traction. The GBP-USD pair closed at 1.3432, up slightly on the day. The technical picture is improving significantly here. The price is pushed firmly above its 50-day simple moving average, which sits at 1.3308. In fact, the pair is now trading above the 50, 100, and 200-day SMAs.
That usually signals a constructive medium-term outlook.
Exactly. The 200-day SMA is at 1.3396, providing a solid floor. The immediate resistance to watch is 1.3464. If it clears that, we are looking at the December 2025 peak around 1.3520.
And what about the yen? We talked about the Takaichi trade weakening the yen earlier, but how did it perform against the dollar today?
Interestingly, despite the broader weakness trend, the yen strengthened a bit today as the dollar retreated. The USD-JPY pair fell 0.30% to close at 158.59. It pulled back from a high of 159.45. However, the long-term trend is still very bullish for the dollar here. The pair is comfortably above its 50-day SMA of 155.95 and way above the 200-day at 149.11. Today looks like profit-taking, but a break below 158.10 could signal a deeper correction.
Before we wrap up, we always like to look at the market movers, the individual stocks that made big waves. It sounds like it was a tough day for a few specific companies.
It was a brutal day for a few names. First up, Biogen. Their shares tumbled over 5%. They announced they expect a $222 million pre-tax charge in the fourth quarter. The market never likes surprise charges.
And I saw Trip.com took a massive hit.
Yes, Trip.com plunged 17%. Reuters reported that Chinese market regulators have initiated an investigation into the travel website. Regulatory risk in China is something investors take very seriously, hence the massive sell-off.
What about the EV sector? Rivian was in the news?
Rivian slid more than 7%. This was a classic analyst downgrade. UBS moved them from neutral to sell. When a major bank slaps a sell rating on you, it's hard to fight the tape.
And finally, AppLovin.
This one was a bit counterintuitive. AppLovin shares fell over 7%, despite Evercore ISI initiating coverage with an outperform rating and a high price target. Sometimes, even good news can't save a stock when the broader tech sector is selling off, or perhaps it was a sell the news event.
It really highlights the cautious sentiment out there right now. We have the tech sell-off, mixed earnings, but resilience in Europe and Japan. It's a complex picture.
It is. All eyes will be made on central bank policy and the rest of the earnings season. Traders are going to be watching that inflation data like a hawk to see if this week's dip is a buying opportunity or the start of a larger correction.
We will be here to track it all for you. That brings us to the end of today's episode. Thank you for the insights. And thank you for listening. If you find this useful, please follow Market Brief After Hours on your preferred platform so you never miss an update. We'll catch you next time.